Welcome to the Financial Freedom Podcast with your host, Lorna Poole, sharing the secrets to creating wealth, investing, and that all-important money mindset. To find out more and accelerate your journey to financial freedom, head on over to www.lornapoole.com to get started. Welcome, everybody. Welcome to the Financial Freedom Podcast. Are you interested in investing in real estate, property? Well, my guest expert today, Erik Engebretson, is a real estate investor and expert in real estate finance. He's been investing in real estate since he was 18. He's owned and managed 2 real estate portfolios. Both are 50-50 mix of short-term furnished and traditional buy and hold rentals. He's also part owner and CFO for Guild Dreams Homes, which is a fix and flip business. Along with being a full-time real estate investor, he also works as a mortgage banker loan officer for 10 years. Erik, great to have you here.
Yeah, thank you so much for having me, Lorna. I'm looking forward to spending some time with you.
Sounds like you're immersed in the whole real estate arena.
Yeah, absolutely. It kind of something that I fell into right out of, well, actually in college. I started with, me and a partner owned a landscape company for many years in high school. And then when we sold it, we rolled in and bought our first rental, which was a house hack in college. So me and him bought it, and then we rented it to 3 friends and essentially lived for free through college. So that's kind of was the start of the journey. And then from there, I've kind of done most things real estate besides being an agent. That's the only thing I haven't done yet.
Yeah, but doing that so young must have gave you the confidence or the evidence that, having your friends stay and you going through college for free. I mean, that must have been a right aha. I mean, like, I could do more of this. Look what else I could create. Yeah,
absolutely. I think it was, I say this a lot. It's like I was so young that I didn't like learning lessons that may have made people pause. We just kind of rolled through, or I just rolled through and was like, these are just normal hiccups. And then it worked out really well being able to live for free in college. And then, we did some renovations to the property and then ended up buying our second traditional rental. After that was a triplex. So that was a huge learning experience. And we renovated those units too. But yeah, I think starting young, there's a lot of benefits to it because you don't know what you don't know. So you just
I think we can get more cautious as we get older. Whereas sure. I think when you're younger, you're just like, be all right. So Erik, let's talk about this. How does somebody go about investing? Like, what advice would you give them?
Yeah. So especially and I don't necessarily just want to say younger people. I think for people at the beginning of a real estate journey, whether you have just never owned a home before, or maybe you just own your primary residence, what I love, there's 2 ways that I love to start. And I think it depends on where you're at. If you've never owned a home before, the best way to do it is house hacking, which is kind of what I was talking about with the college rental, but you can do it without having to be in college, right? So I've worked with multiple people who I've done financing for, where they'll buy like a ranch with a basement and where the basement has a separate entrance. And so basically you're able to buy your primary residence, but split it in such a way that you're able to rent the basement out either on a long-term lease or furnish it and do like Airbnb style VRBO rentals. But not necessarily like weekend rentals, like a traditional vacation rental, but you rent it for like 6 weeks for somebody who's in between, houses, or they're moving to the area or something like that. But it allows you to get into those houses with very little cash out of pocket, right? So you can buy, as a first-time home buyer, you can buy a house for 3% down. So a small barrier to entry to get into a property. And then if you set it up in the right way, you can either live for free, have that second unit pay for your mortgage, which allows you to save additional money to then go and buy the next rental. So that's one way of doing it. The other way to do it, if you already own a home, is is to look at things that you could update within the home, update the home, almost, they call it a live-in flip. And so you basically live in the house, but you update this bathroom, then you update the countertops, you paint the house, so on and so forth, increase the value of it, and then sell the house. And if you live there for 2 years, you don't have to pay any income tax on the gains that you make up to certain levels that are very large. I think for an individual, it's like $250,000. For a married couple, it's $500,000. So most of the time, you don't pay any taxes on those gains. And then you roll that money into maybe a new primary residence with a minimum down payment, and then take the rest of the cash and buy your first rental unit. So I think those are the two best ways to start, is to leverage the way the system's built around your primary residence, financing wise.
Very clever. Both of them are very, I like the idea of, you buy a primary residence and then you have a basement, or you have an area that you can do up and lease out. And if you're leasing the house for 6 weeks in between people moving or anything like that, you can charge more on your rent, I presume. Yeah,
absolutely. So that's, what I built with our portfolios is it's 50-50 traditional, sign a 12-month lease, what everybody thinks about as a rental property, but then also taking especially the smaller units and fully furnishing them with everything you would need, so that a tenant, all they have to bring is their clothes to move in. And you're able to demand a higher rent rate because you're providing that service for them. And then they're also there a short period of time. Typically, I think we typically run anywhere from like 4 weeks to 6 months. And, so you don't get the wear and tear on the properties like you do on a traditional rental, because they're not moving their stuff in, moving it out. It's really more of like a hotel feel, if you will, because everything's already there. So you're able to get more for it. They also tend to be less maintenance. They do take a little bit more work around like managing people moving in and out and getting the units clean. So there's kind of some pros and cons to both sides.
I was about to ask you about that. Is there more work with it? Because if you're talking every 6 weeks or whatever, do you have a management team, or are you doing that yourself?
Yeah, so I do it myself, mainly just because of scale. We have 8 units. So, we're not terribly big, so I'm able to manage it. I think if you get into larger numbers of units, then you probably would need to look at having a manager. The biggest employee / contractor that we have is our turnover team. So we have a gentleman who owns a cleaning business, and I've done business with for a very long time, and he handles all the turnovers. And so I think if you do decide that you want to move into that space to do these long-term stay rentals, is what I call them, you really compete with the extended stays. You're not really competing with like vacation rentals. You're competing with the extended stays, but extended stays have these terrible stigmatisms about them as like not being clean or safe. And so you're providing an alternative to that. But the big piece that you have to have in place is you either have to be willing to turn the units over yourself, which is cleaning, doing all the laundry, the linens and the towels and stuff, or you have to have a turnover team in place, is really the biggest piece that you have to knock out if you're going to move into that space. And we've been very fortunate to have a great partner that does all the turnovers for us. So on my end, the additional work for the short-term rentals versus the traditional is just all the coordinating with people on when they're going to move in, when they're going to move out, answering questions, before people move in. Whereas a traditional rental, you basically put it on a 12-month lease, and the only time you're communicating with the tenant is if there's, some maintenance issues that they need addressed.
I have 2 questions. You said at the beginning you learned lessons. I'd love to hear some of your lessons. And the other question was, are you buying these properties right out, or is there a balance? Do you have a sort of a mortgage or what?
Yeah, I'll start with the second question because it's more straightforward, and then I'll get into some lessons that I've learned. So we've done both. We've paid cash for properties. We've financed the first rental ever, the college rental that has now been sold. We sold it 5 years ago, but we financed it as a first-time home buyer, right? So it was minimal down payment, 5% down, I think it was, and then the triplex paid cash for, and then sold it and rolled that money into some of the other rentals. And it really depends on price point, where you buy them. Bought some properties at the courthouse. For the most part, we do leverage at about 75% loan to value, because it just provides you to grow the portfolio faster. And so one thing that we've done primarily, well, I'll get into that later, but some lessons that I've learned. The biggest lesson was with the triplex. And so I was probably 20 years old when I bought that, and we rented it out really quickly, but didn't run background checks and didn't pull credit. And so that was a big learning lesson, that if you're going to have rentals, you need to have some sort of screening process. And we had no process. It was like put out an ad on, I think, Craigslist and Facebook, and then we rented them. And so then our first string of tenants within that triplex were, one of them quit paying after the first month. One of them had a drug issue, and like cops were getting called to the unit, which obviously the other people that live there are like, what's happening? And so learned a valuable lesson quickly, which is you got to have a screening process. You got to have a process in place to screen people before you allow them to move in, and have a rigid process so that, you're not having to get emotional about any sort of the decision making. It's just black and white. Yes, they meet the criteria, and no, they don't. So that's been a big learning lesson. I tend to learn by my mistakes because I tend to be hard-headed and not learn by others. So that's probably a big one. You got to have a screening process in place.
Yeah, but it sounds like you dive in, which is, a lot of people will sit in analysis paralysis and not move. They want to invest in property, but they're not taking the action, because the best way to learn is by you won't do that again.
Yeah. Yeah. No, I mean, I think that's definitely a strength of mine, is that it's, kind of the, shoot first, ask questions later type mentality, where it's, here's an opportunity, let's take the opportunity. I think it's also important for early real estate investors to know that your downside isn't near as great as maybe it's perceived, right? Like if you buy a property that you're planning to rent on a traditional rental, right? And you buy it, and you get it, and you get it leased, and everything's going well, but then it constantly has these maintenance issues. So you're losing money because you're having to pay money to deal with the maintenance issues, because maybe you didn't inspect it on the front end. That's another lesson that I've learned. You always want to inspect a property, especially a rental, so that you know what you're getting into before you buy it. But you get a year down the road, and it's like, oh, I lost $4,000 this past year on this rental, and I was supposed to make $4,000. And then at that point you say, okay, I either need to learn from these lessons or just sell the property. And, very rarely are you going to be in a position where you like lose the whole value of the house, or you end up, losing tons and tons of money. Most of the time, if you are going to lose money, it's not going to be something that you can't recover from. And the learning lessons that you're going to learn from losing that money are probably worth the money you lost, if that makes sense. And so I highly encourage people to jump in. I mean, obviously you want to have a plan, and you want to map it out and try to avoid pitfalls. I'm not saying you just blindly go do it, but certainly paralysis by analysis can be a terrible, terrible thing to fall into.
And what do you do to choose the property? Like, is it location? Is it, are the numbers going to add up? Like what should you be thinking about in that line?
Yeah. So we primarily invest. So I live in Atlanta. We invest in basically 4 markets, our primary markets. And one is where I grew up. two are city centers that are just north of the city, a town called Marietta and a town called Roswell, where they're kind of the live, work, play type environments where, we've kind of identified these areas that we think are up and coming, that are following the trend of people that want to be closer to restaurants and bars and things to do. And so we've kind of identified those markets, and we're constantly watching those markets, but then at the same time trying to research new markets to get into as well. And then, it's all an analysis from a traditional rental point of view, it's all a cash flow analysis. So it either meets the requirement for our return that we expect, or it doesn't. And if it doesn't, we're not going to buy it. You can't get emotional. That's another learning lesson I've learned is it's easy to talk yourself into something because you just want to do it. But you got to have the process in place, just like that screening process for the tenants. You got to have the process on, if I'm going to put $20,000 as a down payment onto this $100,000 property, what's the return that I have to have on that $20,000 that makes it worth it to me? And what's worth it to me may be different than what's worth it to somebody else. So, I think having a real conversation with yourself and looking at, if I'm going to invest $20,000, what's an acceptable return on an annual basis on that money that I've put in, is an important starting place, because for some people, they may want a 30% return and it'll be harder for them to find properties. Some people may want 10%, 8%. And that's acceptable to them. I think it also depends on the goals that you're trying to get from the property as well. That kind of allows you to identify where to invest and then how to rule in or rule out properties.
And what about, that's for renting. And what about, you were talking as well about fix and flip?
Yes. Yeah. So after about 5 years of the rentals, I bought a rental. It was supposed to be a rental property, but it needed a decent amount of work. And so this is something that I started to allude to earlier, but then I wanted to answer your question before I got ADD and went on a tangent. So we have been doing it for 5 years, bought a property that was going to be a rental near the college that I went to. So we were going to rent it to college kids. And then we renovated it. And one thing that you can do to help grow a portfolio is you buy properties that need work. And after you fix them up, the value of that property has gone up, kind of what I was talking about with the primary residence early on in our conversation. But after that value rises, you can then leverage on that. You can get a loan at a higher valuation and then use that cash that you pull out from that property to buy another one, right? So I'd done that a couple times. And so that was the plan with this property. But once it was completed, it was like, oh man, the value of this has gone up even more than I thought. So we decided to sell it. So sold it. So that was the first foray into fix and flip, and did that heavily for 5 years, from about 2013 to 2018. Basically put the rental portfolio on autopilot and just managed it, didn't grow it. And then did primarily fix and flip properties. And I call them project houses. And, the big thing on that, on identifying the project houses, the financing gets more complex, because if the house isn't livable, you can't get a traditional mortgage. So you have to go either hard money or like I did, I brought in investors, outside investors, and pooled money with that same business partner. I've done about half of all these things that we talk about, I did with that same business partner. And he owns the other half of Guild Dream Homes as well. And so we would pool our personal money. We'd find investors. A couple of our first ones were heavily bootstrapped from friends. We'd get 30 grand from this friend, 50 grand from this friend, and we'd guarantee them a return. But same thing on figuring out your numbers. It's knowing that return that you want on the property, and then identifying a market that you want to be in, and not just trying to shoot from the hip all over the Atlanta area, right? So we'd identify in certain markets that we wanted to be in, and then we would analyze properties. And if it met our return requirement, then we would execute on it or attempt to.
And what about I have two questions coming to my head again. What
Perfect.
about current climate COVID? And the second
Yep.
one is convincing people that are, related to you, can get quite personal in business. How does that work out as far as borrowing money and making a guarantee?
Yeah. So, um, again, I'll start with the second question because I think it's more straightforward. It worked out well for me, and it has worked out well for me. You know, Never brought in family. It was always friends, right? And I maybe that's just my personal experience that I never went down the family path for kind of the obvious reasons of not wanting to mix that. But it always went well with friends. I think the biggest thing there, just like most things in life, is it's communication and expectation, right? So, um, constantly we're communicating what was happening with the project, where we were at, issues that we had. Never wanted to sugarcoat anything. If there was a major issue, told them the major issue. But also the way we structured it. A lot of people want to structure it where it's a share on the return, right? So it's you give me $10,000 and you get 10% of the return, or whatever the numbers are. And for the most part with friends, it's always a set guarantee. So it's you invest $50,000 in this project and I will pay you 1% a month until the project's sold. So if it takes 6 months, then you've invested $50,000 and you get a $3,000 return, but it's guaranteed and it's protected by this asset. So if for some reason I didn't pay you, you would then get it back from the real estate. So you're secured, and then you're getting a 12% annual return on your money, which is pretty good, in my opinion. And we had and then as it evolved, we did end up with a few investors that would put up all the money for projects, and then we would just manage them and manage the crews and the operation, and then sell them. And in that case, we did do splits, 50-50, 60-40 splits where it made more sense. But again, I think if you're going to go down the friends and family route, it's all about expectations, clearly communicate what's going on. And then, on the very front end, either you give them the option, I'll give you a set return, so then all the risk falls on me, even though you're going to leave some return on the table probably, but it's now guaranteed. Or if you would like to share, and if the project goes really well and you want to share in that profit, we can do that. But the expectation is we could lose money, right? Or we could break even. Thankfully, never lost money on a project property. Certainly had some where we made less than we hoped, which I think is a common thing. So that was money from family. And then the COVID question. So in 2018, we slowed down a lot of the projects heavily, mainly because prices here in Atlanta got to a level, that I guess, probably wrongfully took my foot off the pedal because I just got nervous on where prices were going, and it was harder to find projects. You really had to try to find things off the market, or, and the foreclosures were all but gone by then. And so I haven't been in the project market as much during COVID. I'm an investor on one project, but I'm just an investor. So I'm not managing the project in any way. I didn't find it. I'm not selling it. I just provided some capital for it. And all in all, COVID has, when it first hit, I was very concerned about the real estate portfolio and how it was going to impact some of our tenants. And we went and across the board dropped rents 20% for 3 months as a way to kind of, hopefully help out our tenants. And I think a lot of our tenants appreciated that. But we have been very lucky. We've had no vacancy, no missed payments. We had 2 units turn over in July, and we rented them right away with no downtime. So it's been very interesting. In the midst of a global pandemic, I feel like real estate has kind of been insulated in a lot of ways. And it's a kind of an interesting case study on why that is.
Yeah, that's interesting. Eric, this has been an amazing conversation. For anyone listening to this, we've covered a lot, and you really intrigued me with how to get started. What do you want to say to the listener?
I think, I really appeal to the first-time homebuyer, the first-time investor, and what we've talked a lot about is don't be scared to get in, right? And don't be scared to reach out to people and ask them questions on how to get started, right? A great spot to start is with a loan officer that's been doing it for a very long time, because most people's apprehension on getting into real estate investing is the financing piece of it. So if you ask real estate agents for referrals to a great loan officer, or find a great loan officer yourself, someone that's local to your community, I think you can get a lot of information out of somebody that's been doing the real estate finance piece. We didn't talk about that a lot, but that's what got me into the mortgage business in the first place, was my love for real estate investing and wanting to learn more about all the financing side of it. Because if you feel comfortable with the financing side, you're going to be less reluctant to pull the trigger. So I think you just gotta learn, but then eventually just pull the trigger and get into a house hack or a traditional rental. I wouldn't advise with starting with the flips. I would start with just some sort of rental property and kind of get used to how that works. I think that's the biggest takeaway, is just, do it. If you're interested, learn more, but then ultimately don't delay it by just wanting more and more information. Just pull the trigger and get in. Thank you, Eric. And how does somebody find out more about you? I'm kind of antiquated and I haven't gotten into Twitter as much, or really Instagram, but my Facebook is the main spot to find me, and it's just Erik Engebretson, and I'm in Atlanta. So I think if you search Erik Engebretson Atlanta, you can find my Facebook page. If you Google Erik Engebretson North Point Mortgage, you can find my website as well. And then I also have a website, emecompanies.com, that kind of encompasses all the different things that I do as well. And so those would be the best places to find me, but probably Facebook and, the messenger there. I'm pretty responsive on that. And just a quick thing on the loan officer, what do they do? Because I don't know what. Yeah. So a mortgage banker or a loan officer is basically somebody you would go to help you with the financing of your primary residence, an investment property, refinance of a property. Talked a lot about the finance side of it, but that's basically, the job of a loan officer is to help people get financing for homes, for residential real estate, so not commercial real estate. And so that's also what I do for a company called North Point Mortgage. And, so I think knowing the financing side makes people feel more comfortable. So having a great relationship with either a real estate agent or a loan officer is a great first step as well. Thank you, Eric, and thank you for being here. You're so welcome. Thank you. Hey, everyone. Remember to join us in the Private Financial Freedom Podcast Facebook group with me, your host, Lorna Poole. This is a safe haven of like-minded wealth-getting go-getters who, like you, are on their journey to creating financial freedom in their life. This is where you and I can get intimate. I can give you the support and guidance to go from where you are now to where you want to be, developing your wealth mindset and creating your financial freedom life. Join at www.facebook.com/groups The Financial Freedom Podcast. You will see the links to this on the website. It's in the show notes. Or type it into the Facebook group. All you have to type in is Financial Freedom Podcast and you will see us there. Look forward to seeing you in the group. Take care. Thank you for joining us on the Financial Freedom Podcast, to creating wealth, investing, and developing your money mindset. To get started today on your journey, head on over to www.lornapoole.com and grab your free course, 5 steps to breaking free from your poverty mindset and accelerating your journey to financial freedom. See you there.